Aloha, and thanks for stopping by Gates & Associates Accounting and Tax Services Video on Demand series. Today's topic is new Ira tax laws for 2015 and some of the important changes that you need to know. As you know, each year the IRS makes changes to its tax code, and 2014 was no different. Fortunately for everyone, these changes have been made early, and the tax season will actually start on schedule for the first time in 3 years. Each year, our tax professionals spend a minimum of 60 hours learning about the new tax laws and the impact that these have on our client tax returns. Staying on top of important changes can also help you save more money and as well avoid any headaches and hassles. Now, here are some of the key changes to know about. For starters, we're going to talk about the 401k contributions. If you're a current client, you know that at G&A we stress contributing to your work retirement plans as a way to save for the future. If you have a 401k offered through your workplace, you'll want to hear about these changes. For 2014, the contribution limit for 401k retirement accounts is $17,500. Plus, another $5,500 can be used as a catch-up contribution for those 50 or older. We encourage, again, as we said, our clients to maximize their contributions or at least put in up to the maximum amount that your employer is matching. Although there was no change in the 2014 limits, they rise next year to $18,000 along with a $6,000 catch-up for those 50 and above. Now, employer-based retirement plans such as 401ks can be a great way to accumulate savings, especially if you grab all of the employer matching funds available. These numbers also apply to 403b plans, most 457 plans, and the federal government's thrift savings plan. Note that to qualify for the catch-up contributions, you only need to reach the minimum eligibility age of 50 at any time during the calendar year. Now, IRA contribution limits remain the same in 2014 as they were in 2013. The maximum amount, again, that can be contributed is capped for most of us at $5,500, with a $1,000 catch-up contribution allowed for those 50 and older. Here's some other IRA rules changes. Your ability to deduct traditional IRA contributions from your taxable income is income limited, with allowed limits amounts being phased out as your income rises. And we'll chat about that a little bit more shortly. The limits have been made a bit more generous for 2015. However, the deduction for taxpayers making contributions to an IRA for single or head of household, if you're covered by a plan at work, the contribution phases out at $60,000 to $70,000 in 2014. Okay? For those of you that are married and filing jointly, and you have one of your spouses who's making the IRA contribution and is covered by a workplace retirement plan, the income phases out between $96,000 and $116,000. So what does all of this mean to you? Well, basically the amount you can deduct from your tax return for a contribution is limited based on what's called your adjusted gross income. If your income exceeds the amounts noted above, you cannot take an IRA deduction on your tax return. But you can still make a non-deductible IRA contribution. A couple of tax tips for you. Tax tip number 1. Even if you cannot make a deductible contribution, one that can be deductible is one that can be deducted off of your tax return. We encourage you to make a non-deductible one and continue to save for your future retirement. Remember, you will not want to count on Social Security alone for your income when you retire. Tax tip number 2. Be sure that you're keeping track of the type of contributions you're making into your IRA. Deductible versus non-deductible amounts may have a significant tax impact when you start to pull out your monies from your traditional IRA account. Now we're going to talk about the Roth IRA and the phase out that's happening there. So again, let's chat a little bit. What does the IRS mean by phase out? Phase out simply means that at some point, based on your adjusted gross income, the IRS will not allow you to make a contribution at all to your Roth IRA. In 2014, the AGI phase out for married filing joint is between $181,000 and $191,000. Simply stated, if your income exceeds $191,000, you cannot make a direct Roth IRA contribution. Okay? Let me repeat that. If you make more than $191,000 as adjusted gross income and you are married filing joint, you cannot make a direct Roth IRA contribution. For single folks and head of households, This number is 114 and 129,000 is what you're working with. But let me give you another tax tip. If you're phased out, what we're suggesting you do is you contribute instead to a non-deductible IRA, and then at some point in the future convert it to a Roth IRA. Okay? Converting it to a Roth IRA will definitely help you out, because using a non-deductible IRA and then converting it to a Roth will save you on the back end as far as taxes. What we suggest you do is check with your tax professional and or your financial advisor on how to make this happen. Remember, you have until April 15th to make a contribution for 2014. Now, brand new for 2015 will be the debut of the MIRA account. Okay? This was created by the U.S. Department of Treasury and designed to be offered through employers. The MIRA, or My Retirement Account, is small in scale but still useful, especially as a way to start socking money away for retirement. The account, when you open it up, there's no fees and offers what we would consider a modest guaranteed growth, so you won't lose your money. Your principal is protected. Now, you can start a MIRA with just $25 and can add as little as $5 at a time, though obviously the more is better. The contribution limits here are the same as for your standard IRA. Once your account reaches $15,000 in value, it's a requirement at that point that you roll them over into a Roth IRA. For our self-employed individuals, there are two retirement vehicles that you can use to stash money away for retirement. Now, keep in mind that these contributions serve twofold. First, and most importantly, you're contributing to your retirement account. And secondly, you're able to take this contribution as a deduction on your company's tax return. This is definitely a win-win situation for our self-employed individuals. Now, self-employed rises. You can put away up to $52,000 in 2014. In 2015, you can put away up to $53,000. These same numbers apply to your solo 401ks that you have within your company as well. Now, the second type of self-employed individuals have is what's called a simple IRA. And these contributions are also seeing a small uptick. For 2015, you're going to see an increase up to $12,500. For 2014, that number is $12,000. Plus, if you're 50 or older, you're going to get a $3,000 catch-up, again, if you're over that 50 age bracket right there. Other new tax laws for 2015 are worth learning about too, and we strongly suggest you take a minute to review items that may impact your 2014 tax return filing. We know you have a choice of tax professionals out there, and we appreciate you entrusting Gates & Associates with yours. Mahalo for stopping in, and make it a great day.